Great.
Okay, hi everyone. This is Finance Meets Real Estate. We have David Toupin here today. I'm really happy to have him on the show. He's well known on social media and online in real estate circles. He has 100 million assets under management, and he's also the CEO of Real Estate Lab. So which is a multi-family real estate software company focused on managing acquisitions and analysis process for investors, as well as providing market data. So he's going to talk about how he started from an investment banking internship to the point of building 100 million in acquisitions at the age of 26. So he currently has acquired over 1,200 apartments. His key principles valued in excess of the value I mentioned, and he brings his experience in property management, financing, underwriting, acquisitions, asset management, etc. It's really incredible resume there, Dave. So with that, I think it's going to be better to just pass it on to you and hear what you have to say. Like as some of our audience knows, I lean more on the technical side, so I'm really curious to hear about your software as well. So that would be great, as well as your overall investment experience so far.
Love it. Well, I appreciate it, man. Thanks for having me on, and excited to share with you guys. So, yeah, I could just get into my story a little bit, backstory. I've been investing for about 6 years now. I started in college. I've always been an entrepreneur, though, since I was 13. And so always had started businesses, my first being a landscaping company, and kind of did that for several years and a couple things in between. But when I got to college, I ended up studying finance, which I've always hated school. So I didn't really spend a ton of time in the classroom, but I did do a couple internships. So I spent about 9 months in investment banking, where they basically work you to death, 80 hours a week to 100 hours a week, and you're in Excel like 95% of the time. And so I got really good at Excel, really good with the numbers. I've always been a numbers person, highly analytical, and I've always gravitated towards real estate. I started listening to podcasts like Bigger Pockets and whatnot. Heard about, how can you get into real estate without having any money? Because I didn't have any capital to start, right? And so I always wanted to do big deals, though. I didn't want to do single family. So I gravitated towards multifamily. It's made sense to me. Being an apartment investor, apartments are really stable through all different cycles in the market. People always need a place to live. And so that's where I gravitated towards. And after I got out of those investment banking internships, my junior year of college, I went straight into hunting for deals. I kind of figured like the best way to get into real estate and own real estate is to find a deal, right? Everything in real estate investing starts with finding a deal and finding a good property. And I think the toughest part for a lot of people is, well, how do you find a good deal? And how do you know if it's a good deal? Or what price do you offer? Right. That makes sense. How do you know? Like, okay, I drove by an apartment building earlier today on my way back from Starbucks or whatever. And how do you know that it's a good property to purchase, and at what price is it a good property to purchase? And I think that part of the equation kind of came naturally, because to me, I just look at it like it's a business, right? Apartment building makes X amount of income, has Y amount of expenses, and then you have your net operating income below that, which is how we derive the current value and the future value using a cap rate, right? And so it was a simple equation. It's just math. And so I plugged the numbers into the spreadsheet, and I would look at deals, talk to brokers, run the numbers, and I would started making offers. And my first foray into it was I got a 12-unit apartment complex under contract in a city called Garden City, Michigan. I grew up outside of Detroit, and had no money to my name, but I made an offer, got an offer accepted, and I said, I'm just going to figure it out from there. I'll find the money. And so long story short, I ended up syndicating that property. I raised like $150,000 from a couple investors. I got another 500 from a bank, and had somebody co-sign on the loan with me. because I couldn't qualify myself. And I gave the investors 80% of the deal, and I took my 20% for putting it together. And that was my start. And so since
syndicated, Dave Sortner, so you syndicated like a 650,000 deal essentially. That was the first one. So
it was a small one.
But you did an actual SEC offering for it and everything. That's impressive. Yep. Okay, cool.
506B. Yeah. Yep. And I mean, it's weird. I didn't 6 years ago, right? People aren't talking about syndications like they are nowadays. Like right now, it's like rah syndication. Everybody's like hears about it, talks about it. I mean, I don't know if were you in the industry 5-6 years ago, or even before that, right? It wasn't as big on social media and this and that, right? So I just started to hear about it on podcasts and whatnot, and seemed like the way to do it.
Yep.
So, but yeah, I mean, continuing on, I've just been doing the same thing since. I continued, I'm a deal junkie. I love hunting for deals. I love that, grind to find a good property and find the diamond in the rough and find value, and really find the real winners where we can earn a really high rate of return on our capital. And so I've slowed down on syndication since, because I've been doing a lot more joint ventures, buying more assets on my own now. But I've done about 14 properties, 7 full cycle that we've sold start to finish. So I think I'm at about 60 million in assets currently, across 9 properties, and several others I've sold. So it's been an interesting run the last couple of years with how the market's been. It's actually, with COVID and everything, it got even more expensive. Everything became more expensive. So, I focus, I know you said you focus a lot on data. Data is definitely a huge part of it, right? Rental rates, this not. I focus a lot too on, numbers have to make sense, but also what neighborhoods am I investing in? What markets am I investing in? That's really important. So I split a lot of my assets between Austin, Texas, where I live now. Our company's based here, and back in Michigan. So
if I can just kind of recap, at least what I got out of it. So for your first deal, you actually had no capital to your name whatsoever. You went to the syndication straight away. You didn't have your own funds to invest in it. Obviously, you then presumably earned some return on that investment, reinvested into future deals.
Well, yeah, the first one I made no money on, actually. I took an acquisition fee, but I didn't raise enough money to do the renovations. So I had to put it the first $15,000 I ever made in business in real estate. I actually had to put it right back in the deal, which sucked, but I wasn't going to leave my investors hanging. So I put it right back in, finished that deal, made my investors like a 17 IRR on their money. And then, but at that point I'd built some contacts. I was like, okay, now the next one's going to be a little easier, right? Because I've got, I didn't even have investors beforehand. Yeah. So it was a grind to build that up.
Got it. Cool.
So yeah, I don't know if you do a Q&A, any specific questions, or do you want me to just keep going down the line?
Well, let's answer. We have a couple of questions if you like. So we have how did you get your legal docs together for syndication is the first question that we have.
Yeah, good question. So I use an attorney, a real estate attorney. Most real estate attorneys have the ability to do this, especially if you're working with like a decent sized law firm. Like there's somebody there that can deal with syndication docs, SEC filings. And so basically just did some research on attorneys in town, and found one that was real estate attorney, and told him, I'm looking to raise capital. I'm going to raise about $150,000. What do you need from me? And so, they'd ask some questions like, hey, what's the structure of the deal? How long do you plan to hold it? What type of return structure are you going to give them? So, we gave them a preferred return on their money and this and that. So basically it's just finding a good attorney and giving them all the details of the deal, and, a couple week turnaround, normally costs $5,000 to $10,000. Some people spend more, some less. It just depends on the project, but $5,000 to $10,000, you can get a good set of operating agreement and a PPM together.
Sounds good. And so another question that kind of about distance investing is how can you learn more about specific markets from afar remotely?
Yeah, well, fortunately today we have so many resources online. I mean, you could literally go on Google Maps and walk the streets virtually for any market. You just zoom in and drag that little guy onto the street, and you could tour from the street on your computer. First thing I do is, I mean, I'm very specific to certain markets now, but I used to look in a lot of different markets right before I really narrowed down to Austin and Michigan. And what I would first do is I would go to markets that I heard good things about, that I knew people that either lived there or invested there. So I could have some people to ask. And then I would call property management companies. I would call other investors in that market, in that area. And I would start asking questions like, hey, what's a good part of town to invest in? What's a bad part of town? What side of the highway do you want to be on? Is this a good part or a bad part? Is the north side better, south side? Where's the growth? And then start doing research into what's the population like. I always Google what the population of a city, and you could see Google will pull up this line graph of, hey, is the population slowly increasing? Is it increasing quickly? Right? You look up Austin and it's increasing pretty quickly. You look up other cities and it might be very stable or declining. Right? So I look up population growth, job growth, median wages. I mean, all this data you can really find online and start doing your research and figuring out what's a good market. But at the end of the day, what you want to do is you want to go hit the streets. You want to drive it. You want to go walk around, see what's going on, right? You can hear things, but not until you come to Austin, Texas and drive around, and you can't hit a single street without seeing a new development anywhere in the city. It's unbelievable. That's when you start to really feel like, wow, this is a high growth market. There's a lot of money pouring in here. Samsung's got a new office. Tesla's bringing thousands of jobs. Apple's bringing 15,000 jobs next, so you get all this data, all this information. And that's kind of how you can narrow in and pick a market and then start developing relationships and looking for deals.
Understood. And yeah, so the next question, actually, I don't understand very well, but so it's like, how many checking or banking accounts do you need to syndicate? What cap rate do you buy?
Yeah, well, the second one's a very broad question. The first one, how many checking or bank accounts? I'm not sure I understand that either. I mean, normally when I buy a property, I'll set up an LLC. We'll get the operating agreement and the, if I'm doing a syndication, we'll put those documents together, and then we'll set up 1 or 2 company bank accounts. Normally I set up 2 bank accounts for each property. One is an operating account and one is a renovation account where we put all our reserves or renovation dollars in. So hopefully that answers.
Mm-hmm. And what cap rates do you buy typically in the southern market, let's say? I mean, assume like, what are your investment markets so far, David? So it's, you have like Austin, Texas, and what other markets actually? Yeah.
Austin, I have 1 property in Atlanta, but I don't really focus there much anymore. Cap rates, so I mean, it's across the board. Every market is going to be different, right? I mean, nowadays in strong markets like Nashville, Austin, Phoenix, if you're in, Tampa, I mean, we're talking really, really hot, expensive markets. Most properties are being listed between a 5 and a 6 cap is what I've seen, right? You don't see a lot of 7 caps. You never see 8 caps anymore unless you're in tertiary markets. So I would say if you're anywhere within an hour of Nashville, expect a 5 to 6 cap on a sale, or when you're purchasing a property, or lower. If you're close to downtown, lower.
Let's say, if I may interject, Dave, so let's say when you said at the beginning, you try to find like those stellar deals, right? So you look at the value add terms, I assume. So you start at, let's say, a 5 cap, and what kind of improvement in like raising the appraisal are you typically looking at? Like, how much do you try to raise the value? Do you have like a fixed percentage in mind? Like, what is your thought process when doing your deal selection?
Yeah, so every deal is a little bit different. I normally like to see deals where I can raise the value 20 to 40% at a minimum, right? So I just bought a property for 5.6 million. And this is in Michigan. And our end value is about 9 million when we're all said and done with it. So I don't know what that comes out to, like a 35% increase in value or something like that. Every deal I buy has to have some form of value add, whether that's raising the rents, reducing the expenses, just buying it at a discount at a good price, right? But everything I buy, I don't do anything turnkey. It has to be something where we can go in and improve it. Normally we're spending renovation dollars to improve the property. Sometimes we can go in and just raise rents without it. But, that's probably my main criteria, right? It's got to be in a good location. It's got to be desirable. I won't buy a property in the middle of nowhere. I don't want something that's completely falling apart unless it's in a really good location. So I look for stuff that's in pretty good shape, that just needs somebody to come in and have a vision for what it could be and improving it.
So the property you just mentioned, that was in Austin as well, you said, or?
Michigan.
That was in Michigan. Okay.
Correct.
So that's like what market over there?
It's in a city called Royal Oak.
Okay.
And it's right across from the biggest hospital in the state, called Beaumont. So it's in like a A- area, I'd say.
So that was like, what was like 5.2 million up to 9 million improvement in the valuation. Yeah. That's amazing.
5.6 up to 9.
5.6.
Yeah.
That's great. Awesome.
So we'll be all in at 7.2 million. And the goal is to sell it and make about $1.5 million after costs. So we'll double our money that we put into it. Me and some friends put $1.5 million up, and our goal is to double that within like a 2-year period.
But would you say that, if it's sort of classifying Michigan as a kind of mid-range, not a depressed market for sure, but kind of mid-range. It's not, Austin by any means, or like a broad state. Like most of the markets there, obviously they vary, etc., are not in that category. And so, would you say that the magnitude of the spread you're seeing relates to that it's a kind of a market of this kind? Would you find a similar spread in Austin as well, or what's your experience?
Yeah, it's all relative. Like the same property in Austin probably would have cost 8 million to start or more. I bought it. It's, the reason I invest in Michigan really is just because I grew up there and I know the areas, I know the streets, I know which towns to invest in. And I only buy in a couple specific parts of the Metro Detroit area. I won't invest in Detroit at all. That's not really a focus of mine. Some people, are hot on downtown Detroit right now, but if you've grown up there and you live there your whole life, right, it might seem cool what's going on in Detroit and the growth, but it's nothing compared to a lot of other major markets. When you go to like an Atlanta or a Phoenix or Denver, Metro Detroit, Michigan is not a great market statistically overall, right? But for me, it's a good market because I know the hot spots and I have a lot of connections to find good deals there. So I think that plays a part in the process. I always suggest people invest in your backyard first, because right? If you're looking at a deal in Memphis and great, it's $30,000 a unit. It sounds like a great deal. Rents are $750 a month, but you don't know what part of town it's in. It could be in the hood, right? It could be in an area that's not desirable. It could be in a D location where you could really find yourself in a tough position getting out of that property in the future. So invest in your backyard.
The one in I didn't remember the name of the town specifically in Michigan. The university. There was how many? Yes, there was how many units actually?
It was 52 units. Yep.
52. So that's not terribly cheap at all. Actually, that's like.
Yeah, I bought it for $107,000 a door.
Yeah.
Not cheap.
Yeah, not at all. Yes, is that?
But it's in an A-class location.
A-class.
Yeah, it's an A-class location. Yeah, it's right across from a big hospital. Homes in that area all average, $400,000 to $700,000. It's high median income area. Our rents, when we're done with it, will average about $1,400 to $1,500 a month. And I own other properties in the area, which we've sold for in excess of $150,000 a unit. I have a similar property. Actually, I have an offer on it right now for $190,000 a unit. that I bought for 65,000 a unit. So, you know, you know, the area, it starts to make more sense when you have the data behind it and you know the area.
Got it. Yeah, that sounds awesome. Those are great deals. So actually, so another question I have in the chat is, do you recommend finding the deal first or the investors? What is your typical pitch when investing?
That's a great question. Yeah, deal first or investors. I mean, that's always like a toss up. People are wondering, right? How do I get started? Do I need the investors before the deal? I mean, call me crazy, but when I went and found my first deal, I had 0 investors lined up. I did not know where I was going to get the money, but I knew that I could find it, right? I knew that if I worked hard enough and really hustled for it, that I would find people. And I had a lot of people tell me no, that I thought I would get to invest, right? You know, friends and family type people that I was counting on. And I'm like, oh man, I'm going to get some of these guys to invest for sure. And then you start getting, well, no, I'm not interested. Or people you thought that had money don't have money. But in the end, what really works in your favor is a good deal should help sell itself, right? If you bring a good deal to investors that have capital, that are sophisticated, right? You know, small business owners, high W-2 earners, right? Those people, they're savvy enough to understand what's a good deal or not, even if they're not in the industry. So if you can put together, and this leads to the next question, how to raise capital, how do you pitch investors, right? The deal needs to have a good story and it needs to have numbers that support it. So if I can go and tell investors, hey, we're going to buy this property for $500,000, the NOI is here. I'm going to raise the rents $150 a unit by putting this much into it. The NOI is then going to be here at a 6 cap. It's going to be worth $900,000 now. And we could sell it and make 300 on it. They're going to be like, oh, great. This sounds awesome. Sign me up. Right. But you need to have that story. I'm a fan of deal first because without a deal, all the investors in the world doesn't matter. But what I suggest is if you're not as crazy as me and you want to have some peace of mind going into a deal, maybe do 50-50, right? 50% of your time, look for a deal, 50% of your time, look for investors. But just realize that your first deal, you're almost never going to have all the money lined up before you go into it. You have to pull the trigger and just do it.
You mentioned you said call yourself a deal junkie, right? So you kind of like looking for deals really much. So what's your approach? Because in the commercial space, like it's typically broker relationships or sending direct mail, like direct to owner advertising.
Yeah. So finding a deal to me, I mean, it's like you have to create a network around it. You have to let everyone know you're looking for a deal. Talk to brokers in the market that are selling properties. If you're looking for small multifamily, 4 to 10 units, you could even talk to realtors that have some experience doing those type of deals. Put the word out on social media, go to meetups, right, in your area, and just spread the word that, hey, I'm looking to buy 20 to 40 unit, if for example, 20 to 40 unit multifamily buildings in, the north side of Atlanta. If you find something, let me know and get on the phone with brokers, right? That's going to be your best source at first is brokers. If you want to go more off market, you can do what people do in single family, get a list and cold call, right? You can cold call owners. You could send letters and mailers. I've done that. I've gotten some really good deals from sending a letter to an owner. So there's a lot of different ways to find deals, marketing, just spreading the word. Nowadays, I do a lot less effort to go and find a deal because a lot of deals come to me nowadays. And I mean, it took several years to get there. In the beginning, you really have to hustle though, and put that word out and meet with brokers, tour deals, make a lot of offers. I would expect, I would set the expectation that you're going to need to look at 25 to 50 deals and make 25 to 50 offers before you get one accepted. Like if you set that as your expectation, right, go into it thinking you're going to have to look at a lot of deals to get one. I think you're going to be in a really good position.
And another question is why equity side of real estate instead of debt? I mean, I guess like why syndicate instead of just simply work for, well, I guess, or work for debt
Yeah.
investors, I guess, like personal promissory notes, etc.
Is that what you meant, Andy? Like why bring in like partners instead of just private money?
Right, exactly. Like debt side, like maybe lending and providing capital instead of like equity side where you're buying properties.
Oh, I see. So why buy properties instead of like actually lending
Yeah,
on
like raising
properties?
capital and yeah, lending and earning the interest and stuff.
You could just earn much higher returns by being an owner, an investor in property. And I didn't have money to lend in the beginning, so at this point, I have done some small hard money loans, but I still always get, even if I'm making 12% on $100,000 that I invest for somebody, like I'll always make more than that if I go and put that 100,000 into a property. My motto is double within 2 years, 2 and 2. And I've been fairly successful at this. And I think a lot of people, if you're really hustling in the real estate game, it's not hard to find deals where you can go and invest $300,000, improve a property, sell it, and pull out 600, right? Your original 3 plus another 3. And so, you can't do that in the lending game.
Gotcha. Thanks.
Yeah, no problem. Good question.
Do you get a deal under contract with an official offer or a letter of intent? Is another question.
Yeah, great question. So we start with an LOI, which is normally like a 1 or 2 page document, really simple, just outlines the terms, purchase price, closing timeframes, earnest money deposit, just basic terms. Send an LOI, and you send a lot of these out, right? It's a non-binding document. Basically, we ask them to sign it, right, as like a soft commitment. But we'll send out a ton of these LOIs, and we don't really get many of them accepted, but the one that we do get accepted, we will then send to our attorney, have them put together a formal purchase agreement, which is, unfortunately sometimes like 40 or 50 pages long. And we'll send that over to the seller to sign, which is like a formal contract to purchase.
Can I ask one question?
Yeah, what's up, man?
Yeah, so when you send the LOI, do you and you get it on a contract, like at what process would you recommend seeking for investors at that point? You get what I'm saying? Like,
great question.
Letter of intent, you got the attorney, you send the attorney for the agreement, you got all the terms and stipulations. Now you're ready for the deal. See, what I'm afraid of is like the financing falling through at that point.
The funding. Yeah, that's always like the chicken and the egg type of thing, right? So what I suggest is you get an offer accepted. You get a signed LOI, you get an offer accepted. Let's say within a week or 2, you're working on getting a purchase agreement signed. During that time period, before you lock the deal up, let's say it's a week, put together a package for the deal for the investors, right? So get your pitch deck ready, or anything you plan to send to investors, any type of literature to help pitch them on the deal. Put that together, and the day you go under contract, have that plan in place. Start raising money. The day I'm under contract on a deal, or even before under contract, I'm talking to banks, because banks can take a little bit longer, right? If you have, let's say, a 60-day closing time frame, sometimes it's cutting it really close with banks. Sometimes I end up taking 75 days. So a tip I'd give you is right when you go under contract, start raising money. Before you go under contract, I think it's safe to talk to banks. I suggest not raising money before you go under contract, because people talk and you don't want somebody else hearing about the deal and then going and messing it up. So wait till you get it locked up, talk to investors. But then start raising money from investors right away. And then, hopefully within that time frame, you should be good to close. I always bake in to every purchase agreement up front an option to extend. So I'll do a 30-day due diligence period, a 30-day closing after that. So that's 60 days. And then I always put in the contract that, let's say it's $1 million property, for $10,000 additional earnest money, I can buy myself another 30 days. And then I don't have to fight with the owner if it comes down to the wire about, hey, I need 10 more days. I just have it in the contract. I send in my 10K and I say, hey, I'm exercising my extension. So, and you might even be able to say 2 extensions of 30 days for 10 grand, or first one's 10, the second one's 20, or, however much it is. But yeah, that's what I suggest.
Yeah, Nelson, go ahead.
Hey, first of all, Stefan, as always, I'm extremely excited and happy to kind of guess that you have on. I had some technical difficulties getting on board, so it's called Finance Meets Real Estate with Nelson. With me, it's called Nelson Meets Zoom. So, David, I didn't catch the first part. What's your sweet spot for property? What kind of properties are we looking at here? What size?
Yeah, so I do almost exclusively apartments. I have some commercial buildings, but in very specific areas. I will do, man, if you met me 4 years ago, I would have said I only buy 100+ unit buildings when I was solely syndicating. Nowadays, like I just went under contract on a 14 unit. But I'm really excited about it because it's like right downtown in a city called Ferndale, Michigan. And it's on Main Street. And I'm going to do it's a historic building. I'm going to do really cool renovations to it. And so I'm really amped about a 14 unit, but I'm only buying that with like me and 2 other friends. So it depends on the deal. I'll go up to 200. My biggest property I've bought is 230 apartments. And I'll do anything in between. I just look for good deals. Whatever is a good value add, I'll do.
So my second question is the change in size, is it because the pricings are so I guess inflated? I'll use that term.
I mean, really the difference in like the size of what I buy, it's like, it comes down to what I can find. If I find a 50 unit property that's a really solid price and that I really believe in, I'll buy it. I'm an opportunistic investor. If I find opportunity, I'm going to go for it. I'm not going to really go and spend a lot of time on a 6 or 8 unit property. And I normally wouldn't buy something under 20 unless this was a very specific one, just because I put the same amount of time into buying this 14 unit as I would 150 unit. There's just more money to be made in bigger deals.
Right.
But if I find a good opportunity, I'll normally jump on it.
Okay. And then you talked about, I don't know if you talked to your team. How are you set up? Because I know you said you like to go after deals. How are you? What does your organization look like?
Yeah, so it's myself. I have an asset manager and I have an underwriter. And so I do a little bit of asset management. I kind of cross over everything. I do a little bit of everything as well.
Excuse me. So you raise capital and you go after the deals too? You do both?
Correct.
Okay.
I raise capital, go after the deals, line up the financing. My favorite part is from finding a deal to getting it closed. And then my team will take over after the fact, asset management, managing renovations, that type of stuff. I don't get too involved in that area.
Okay.
Yeah.
And how are you able to manage the time between raising capital and going and getting deals?
I just work more hours. It's I mean, I don't know. At this point, it's all kind of just flows together. Capital. There's a lot of capital out there nowadays, and they're looking for places to put it. If you're well networked, and so I don't think the capital is too difficult at this point. It's really mainly, hey, when I going out there and making sure I find a good opportunity and then locking it up, because it's so competitive, right? Even if you find an off-market deal, a lot of times there's already two or three other people looking at it, and so my specialty is going in, finding a property and taking it off the market within 24 hours. Even if there's other people looking at it, making a really strong offer and getting it locked up. And then my next part is getting it closed, getting it over the finish line, making sure we've got the funding in the bank lined up. I don't really like doing the next part, which is asset management.
Yeah, that's the other part. And then just to kind of wrap it up, when you said you in your contract, you're putting in the earnest money, the additional extension, is that money also going hard immediate, or is there some kind of escape clause because heaven forbid, you end up unearthing some gigantic problem that's insurmountable. And you're like, you know what? This guy was really hiding this. We found it during due diligence, and now our money is hard. Can you talk to that a bit? If you have something around that?
Oh, absolutely. Yeah. So there's definitely a lot of options in how you structure a deal when it comes to earnest money and the timelines and inspection periods. I think everybody does a little different. 4, 5, 6, 10 years ago, you could get away with putting refundable earnest money up front a lot more often, right? I could put on $1 million property, I could put a $25,000 deposit, have a 30-day inspection period. And if I don't like the property, I could walk away for any reason. Definitely still possible to get that. If you're looking at on-market deals in any major market, I would say nowadays it's almost impossible to lock up deals with refundable earnest money. It's really difficult. If you find an off-market deal, mom and pop owner, 100% refundable earnest money, put that in your LOI and you should be okay. Normally though, after your 30-day inspection period, that money is going to become non-refundable. And so will any additional earnest money you put up after that. So the only workaround I'd say is if you want to be competitive still, make, and this is how I lock up deals and I lock them up quick. I do non-refundable earnest money day one on every deal I buy. And it's because I know what I'm buying and I believe in it a lot from the start. And so even though I haven't fully inspected it, I'm going to throw $50,000, just let's say earnest money from day one. That's how I get the deal locked up. I might put an additional amount of earnest money after another 30 days. And that just to the seller shows them like, hey, this guy's super committed. They're going to close. If you want to work around that and still put some non-refundable, maybe you put $10,000 earnest money non-refundable from day one. You can still get out for 2 reasons. There's always an environmental out in case I find something underground. And then there's always a title out, right? If there's something that's clouding title, obviously you can't buy the property. So those are the 2 outs, even if you have non-refundable, but put down like 10,000 non-refundable up front and then maybe the other 40 after 30 days. So you're only risking $10,000 for those first 30 days. And then the rest of it will be risk money after the fact, but you've at least had a chance to inspect the property at that point. The only other thing I'd say, Nelson, that you as a workaround, if you don't want to do that, or if you have to put hard money down day one to get the deal, is send in an LOI that says, I will put down $50,000 non-refundable day one while we're putting together the purchase agreement for the next week or 2 or the next 10 days. Allow me to inspect the property 1 or 2 times with a contractor. And that maybe before you go under contract even. And sometimes I've seen people get away with that, and that buys you a week or 2 to at least do like some kind of major, or a small inspection to knock out any of those major concerns.
Yeah. Is there some kind of I don't know, a ratio that you use with your earnest money? Because that's a pretty nice, you're using it as a weapon. Okay. As a weapon, is there a ratio that you have, like 1% or 0.5%? It's like a dangle that you have.
It is. Yeah. 1 to 5% is very common. Starting at 5% for smaller properties, going up to 1% for, $10 million properties, right? Normally, if you buy a $20 million property, you're normally not going to put $2 million or $1 million in earnest money, 5%. But if you're buying $1 million property, you might end up putting $25,000 to $50,000 down. So
right, but in the way that you're using your last example, you use it by stages.
Yes.
You said, yeah. So can you talk more about that, of how you're using those stages? So for example, you said, okay, look, I'm looking at $50,000 earnest money. However, for the first week or for the first 2 weeks until we get the purchase and sales agreement done, you've got this 10,000 hard. So they're nibbling on that. While you've got those 2 weeks to scramble, inspect everything as much as you can. Can you talk a little bit about that? I mean, that's a great strategy.
Well, so in that scenario, you actually don't put any earnest money down because you don't have a purchase agreement yet. So so let's say you're selling me a building. I send you an LOI. You're like, okay, I like the terms. Let's go under contract. it's going to take the attorneys 2 or 3 days to put together a contract if you're quick. And then they're going to get it. They're going to give it to their attorneys to review it, send you back comments, right? So it's a whole probably like 10-day process just to get a deal signed sometimes. And you get lucky sometimes and they'll just sign it. And I'm like, whoa. But in that time period, you haven't put any earnest money down. And I would just make the ask up front. I'll pay you this price. I'll give you the hard money. But while we're putting together the purchase agreement, I want you to let me inspect the property. So that buys you a week without any earnest money.
Yeah.
Then you could put down, a small amount, maybe 10,000. And then you could say after 30 days, after my inspection period's over, I'll put down another 10, 20, 30, 40, 50, whatever it is.
Dave, I know, sorry to interrupt. So I know
Thank you.
No problem. Yeah, and thank you, Nelson, as well. I know you have a hard stop in about 10 minutes. So let's try to go over like some of the other questions. So you have another question we have is, we went over the underwriting process, I believe, partly at least. So what do you think of Airbnb for someone starting off and has a job during the day? Is another
Airbnb?
Yeah, for someone starting off who has a job, who has a day job.
Yeah, I think Airbnb is great. I don't own any personally. My girlfriend has a couple, and she does very well on them. And so I think that if that's something, I always tell people this is not a side job really, right? Like you can have it start as a side hustle, but if you want to buy apartments and grow apartments and you're not just flush with cash, just able to buy them on your own on the side, right? You want to syndicate and you're starting from maybe like I did, you don't have a lot of capital. It's a job, you're starting a business and you have to treat it like a business. So if you're not ready to make that commitment and really put a ton of time in on the side, to grow it, then yeah, buying a single family, Airbnb it out, I think is a great strategy. Like I'm just a fan of real estate in general. Any real estate is good real estate. I don't agree with Grant Cardone in that you have to start with 20 units, right? And that's the only way to get in the game, right? If that's not your really desire, like, yeah, definitely go start with a single family Airbnb, rent it out. It's a great way.
I got a question.
What's up, man?
I joined in late. Will there be a replay of this Zoom call?
Yeah, Travis, it's going to be posted on YouTube. So I'm going to put in the YouTube channel once again. And
okay.
Right, yeah, it's going to be posted there.
Okay, thank you.
Okay, yeah, thank you. And so another question, like what are the valuation techniques you use? Cap rates, comps, replacement value, income approach, DCF? I think it's the 2 and 2, right, Dave? Like you said, sounds to me.
Double it in 2 years, man. That's what I like. Yeah. Valuation techniques, Andy. Could you clarify, Andy? Are you talking about like how am I finding the value up front to offer, or?
Yeah, the purchase price. Yeah, to offer basically. Like okay. Use comps, like use CoStar or RCA or stuff like that.
Yeah, definitely. Good question. So a part of it is using comps, but really, if you're familiar with commercial real estate, every property is different and we use the income. We use the income of the property to value it. So I always ask, you get 2 documents up front. You get a rent roll, which outlines every unit, what their rents are currently, which ones are occupied and which ones are vacant. And then you get a T12, which is the last 12 months of operation. You normally want the T12 like as near to your current date as possible, just so you can see truly what's going on every month by month over the last year. You can see what their monthly income is, monthly expenses. I'm going to look at what is their income minus what their expenses is, or what their expenses are. And that is going to give us an NOI over a 12-month period, an annual net operating income. If you want to be really simple, you could take that NOI and look in your market. Hey, if things are selling at a 5 cap across the board, divide that NOI by 6.5, right? And that could give you a 6 or 6.5 or 6.25. And that could give you like a pretty basic valuation of what might be a decent price to pay for the property. I don't recommend just outright doing that because I think you really need to dive in more. I use a financial model, an Excel spreadsheet, which I've built, which you guys can I have actually a free one too, which you guys could get a copy of. I'll throw a link in here if you want it. I think it's on this website, learn.realestatelab.com. I actually have a software program I'm building to help people analyze deals as well. Maybe we can chat about. But I will throw all the information and the numbers into this financial model. And then I will throw in my assumptions. What do I think my expenses are going to be going forward? What do I think my rents are going to be? What are my renovation costs? What are the loan terms that I'm expecting from the bank? And then I throw all this into a model, and then I see what type of return on investment it's going to kick out at a certain price. If the return on investment is not very great, I'm going to drop the price down a little bit. The less you pay, the higher your returns are. In commercial real estate, you make money when you buy. That's the end all be all. You make money when you buy, you make money when you buy, you make money when you buy, not when you sell. And what that means is if you pay the right price for a property, you're going to make money. So yeah, we use cap rate, NOI, cash on cash, IRR is another one, internal rate of return. We will look at comps like, hey, has something else sold for 100,000 a unit in this area? If so, I don't want to be paying 125,000 a unit for, the same type of product. But maybe that property for 125,000 a unit has really big units. Everything else was like 600 square foot units and their rents were 900. Maybe this property has all 3 bedrooms that are 1,400 square feet and it's got really nice amenities and the rents can go up to 2,000. Maybe that justifies paying a price. So it's hard to compare apples to apples because every property is a little different.
Great. Thanks a lot.
Yeah.
So next question, on the construction renovation side, how do you earn the construction business in the value add side, and what do you think of development versus hold versus fix and flips, etc.?
How do you wait, was this how do you finance the renovation, or this was a different one?
How did you earn the construction? Well, yeah, no, actually a bit more up.
Oh, I see.
Yeah, it's
okay.
We can combine maybe, but how did you earn the construction business and the value add side, I guess? And what do you think of development versus hold versus fix and flip?
Yeah, so construction in the value add side. I learned by being really hands-on. The first 3 properties I bought, I was the general contractor. I went and bid out the roof replacement. I went and bid out the parking lot replacement, the unit renovations. I worked through 3 or 4 different subcontractors to renovate units. I figured out what the pricing is, what the pricing should be for certain things, what's too much, what's, not enough. And so I started really just being really hands-on with it. And I spent a ton of time just learning and managing those renovations until I got to the point where, it started making more sense to me. So a lot of mistakes along the way, obviously, but that's kind of how you learn. And so that's how I got into the value add construction side of things. Now I mainly hire general contractors that will handle all the work because I want to be hands off. But at least now I know, hey, if a GC is giving me a certain price, I can tell if he's crazy or if I need to go find another bid. What do I think of development versus hold versus fix and flip? I'm doing one new construction deal right now. I'm building a 50 unit in North Austin, and I'm not a fan. I don't think I'll be doing it at any point in the near future. Development takes so long to make money if you're syndicating. Whereas I can go and buy a 75 unit apartment complex in next month and I can flip it within 2 years and make $1 million, right? Now I go and develop, it's going to take me 2 years just to build it and then and lease it up. And then I'm finally making cash flow. Whereas, I can go buy a property right now and make cash flow day one. So I definitely like buying existing properties more than development. And then hold versus fix and flip. That's the age old debate. I'm always constantly debating myself. Do I hold this property? Do I fix it? Do I flip it? I do a mixture of both. If it's not in an absolutely killer location that I think will go up significantly in the next 5 to 7 years, I'm okay with flipping a property in under 2 years. If I'm buying a property and I'm projecting out a 5-year valuation, for example, I bought a property for $4.3 million, $4.2 million back in 2017. And my 5-year projection was that I'd sell the property for like, I bought it for 4.2 million. My 5-year projection was I would sell it for 7 million. After 18 months, I got an offer for $7 million and I took it because I'm making my 5-year projection in under 2 years, and we doubled the investors' money. For me, that was a big win. So I flipped it. And nowadays I wish I held it, but it is what it is. We made our money, we moved on, we did more deals. So I think you do a healthy combination of both. You hold some properties, you flip more.
And so part of the same question, how do you also approach deals when everything seems to get bid up? I guess
you look at more deals.
Yep.
Yeah, you got to find more deals, make more offers.
How do you finance the renovation work, and how do you find contractors?
Sometimes we finance renovation work through bringing cash to the table. For example, let's say I'm buying $1 million property and I need 300,000 renovations. I'm going to put 20% down on the purchase. So I'll put $200,000 down, and then I'll bring $300,000 in cash in addition to renovate it. Sometimes a bank will lend us that money. I only need to bring $200,000 down. The bank's going to lend me $800 to purchase it, and then they're going to lend me another $300 to renovate it. I prefer the latter, which is having a bank finance the renovations because interest rates are so low. So.
And what about finding contractors? It's really hard to find contractors whom you can trust, right? They frequently kind of, can mess up your deal essentially. So
yeah, referrals are the best way. Get a referral from somebody who's in the business. I mean, there's tons of good contractors out there. There's even more bad ones, but everybody, if you've been in the business a while, most people have good contractors they work with. It's hard to get a referral out of certain people if you don't know them very well, right? Like if somebody random asked me right now, like, who do you use in Austin? I might be wary to share it because he's doing such a good job on my stuff, right? I don't want him running off and doing, but close friends, I'll definitely give referrals, stuff like that. And so, make friends, network in the industry, and you'll get referrals to give people.
Okay, sounds good. So I know you have a hard stop, Dave. So let's go last question on the chat, and it's also my question. So let's go over the capital raising side. So I see you have 110,000 followers on Instagram. Is that how you capital raise? What's your approach?
I have raised a lot of money. I've raised several $1 million through social media at this point, but the main is just. Nowadays, the main I would say is just like warm leads, referrals, that type of stuff, referrals from people. But it took a long time to get good at raising capital. it was really difficult at first for me because I was 21 years old with no track record, no money myself to put in the deal. So I couldn't even tell investors I have skin in the game because I didn't. And so it was really difficult. Like I had to really sell people on it. And I had 10 to 1 people would say no. So to get my first 20 investors, I had 200 people say no. But I performed on those deals. So then those 20 people went and told their friends. So they brought another 20 people, let's say, if each one of them referred one. And then I go back to the original 200 that said no. Now that I've done it, I got another 30 or 40 of those guys to invest with me. Right. And then they tell their friends. And so fast forward 5 years, I have over, I think about 150 investors total, net from the beginning. But it's just a long game, right? You're going to find some people on the way that want to, and you're going to find a lot that don't. Stick with the ones that like investing with you, ask them for referrals, keep networking for new ones. It's one of those things that just doesn't come overnight. It just takes time. It's simple. There's no secret sauce to it.
Let's say, so that makes sense, but let's say purely on the automation and kind of building your social media side. How do you go about that?
So raising capital on social media, the easiest way is talk about what you do. I'm an apartment investor. I put it on my story. I put it on in my posts. That's all I do. My social media, I use it for business. If it wasn't for business, I don't even want to be on there, to be honest with you. I don't like social media like that. So, talk about it, right? You got to get on. Like today, I was out touring some of my properties. I did some selfie videos of what I was working on, the financial and the numbers of the project. Like, hey, I bought it for this. I'm putting this much into it. I'm selling it. Even if you don't own any properties right now, get out there, show that you're touring properties. Like, hey, I'm looking at this deal. I'm looking to go put this together, earn a good return for investors. If you're interested in investing in projects, let me know. Let's get on the phone and chat. Do that consistently every single day for a year, and you'll start to find some traction. It's going to take time though.
Hey, David, can I ask you one more question, man, before we wrap up? Okay, Stefan.
100%.
Is it okay, Stefan?
Yeah, sure. No, go ahead.
Okay. Yeah. Back to one you were saying with the earnest deposit. So when you said you act kind of more so aggressively to get the property under contract, specifically you stated 24 hours, I'm assuming you're using the earnest money tactic as well as maybe even overbidding a little bit. I'm just assuming, just from putting in offers myself. Now, if you're doing that as far as overbidding, once you get the property under contract, you do the LOI and the agreement and stuff like that, what are maybe your tactics to maybe get that price back lower to a realistic number, to a better number? So for example, if they wanted 1 million, maybe you're going in at 1.1 or something, just for an example, and then doing the earnest money thing. How can you get that property to 900 or even 850 or 700,000 at that point?
Yeah. So, well, I think you want to avoid what we call in the business, that would be like retrading on the property. So, because I think word travels quick, right? And I think reputation is really important. People get a sour taste in their mouth when you tell them you're going to buy a property for a certain amount and then go back and afterwards say, I need this price to be lower. Unless there's a good reason, right? I'm all for retrading a property if you have the expectation going in that was set by the seller that you're buying. Like, let's say, for example, they advertise it as a 22 unit property, and you go in there and you find out that 2 units were in the basement. They don't have an egress and they're not up to code legally as units, right? You legally can't be renting it, and the owner didn't tell you. They hid this. You have every reason in the world to go back to them and say, hey, I need $100,000 off because these are non-conforming. You did not tell me this, right? It was undisclosed, or there was a huge foundation issue that you didn't know about, right? Go back and you get money off to help cover the cost to fix it. But I don't go under contract with the expectation that I'm going to retrade it. I want to go under contract with the expectation that's the price I'm going to pay. I don't overbid. Let's say they're asking $1 million and they're getting offers for 900, 925. I might come in at 875, but I'm going to give you $50,000 hard money day one. If I walk away from that deal, you get my 50K. If I don't close because I couldn't put the money together, you get my 50K. I have less leverage to retrade because if I tell the guy I want him to reduce the price now, he could say screw off. He gets to keep my 50K. So I'm giving him certainty of close. And that makes a lot of times them want to work with me.
So you're just being, sorry,
yeah. No, I was just gonna say an example. This week I had a property, they want 1.6 for it or 1.7 for it. And I know they had 2 offers in the 1.55 to $1.6 million range. I offered 1.5 million, but I gave him hard money day one and I'll close within 60 days. And he liked that. And I knew he'd like that because he had somebody recently tell him they'd pay him 1.7. They got on a contract. They wanted him to bring the price down to 1.6, and then they backed out. And I was like, this guy just wants somebody that's going to close. And so I became that guy. So, yeah.
So your tactic is just being very firm on the price up front, knowing what you're going to pay, and then setting hard stipulations for yourself and expectations for yourself with earnest money. Is that accurate?
Correct. 100%, man. Yep.
Okay.
I come in strong.
Gotcha. I actually have a deal that I'm looking at. I would like to go over with you if you have time. I don't know if you offer some kind of mentorship program or I could maybe pay for a consultation, but I would like to go over a deal with you actually.
Yeah, shoot me a DM on Instagram or shoot me an email. I'll put my email in here.
Okay.
I don't really do like one-on-one coaching, but I have a real estate community where we do go over deals and stuff like that on Zoom calls. So
what's your Instagram?
Real Estate Jedi.
Cool beans.
Sounds good, bro.
So which one are you, Darth Vader or Luke Skywalker?
I'm Yoda, bro.
Okay.
Love it. No, I created that name because one of my friends, he always used to call me Yoda because I would help him underwrite deals, and he's like, dude, you're like Yoda with the spreadsheets. So I just kind of stuck. But yeah, well, thanks for having me, Stefan. This is fun, man. Got a good group here.
Thank you as well. That was great. Impressive stuff. Great.
I actually couldn't find your Instagram. You said Real Estate Jedi.
Yeah, Real Estate Jedi, David Toupin. I'll put it in the chat.
Okay, I got it right.
JEDI. You find that? Cool.
It's Real Estate Jedi what?
Just Real Estate Jedi.
And that's your Instagram.
That's
And
my
email?
Instagram. My email
Right.
is david@realestatелab.com.
Thank you.
It's on the chat. It's on the chat too. No,
Yeah, I threw both
okay.
of those in the
Yeah.
chat for you guys.
Yeah.
Ah,
Okay.
great. Thank you.
Last question before we wrap up.
Sure.
You guys have? No? Okay. That was really great. Thanks, Dave. Thank you everyone for joining as well. So this is going to be on YouTube. Thank you for being here today. Goodbye.
No problem. Thanks, guys. We'll see you.
Stefan, thank you. David, thank you.
No problem.